Every financial media outlet covering the BRICS story is asking the wrong question. They are asking, will BRICS create a new global reserve currency to replace the dollar? And then almost universally they answer, probably not anytime soon. The BRICS currency is not the threat. It was never the threat. The threat is something quieter, something more structural, something that does not require a summit, a press conference, or a single new institution to be built. The threat to dollar dominance from BRICS is not a cannon shot. It is a slow drain. The difference between the dramatic event that makes headlines and the structural erosion that changes the world is exactly what most silver investors, financial media, and advisors are getting wrong. Today I'm going to show you what the BRICS threat actually is. Not the doom version, not the dismissible version, the real structural version backed by data. This is episode 2 of the Petrodollar Collapse Series. If you haven't watched episode 1, I want you to do that first. By the end of this video, you will understand why the BRICS currency is a red herring, the 4 real mechanisms, why it matters for silver, and the updated scorecard. BRICS started as an acronym invented by a Goldman Sachs economist named Jim O'Neill in 2001, describing the 4 largest emerging market economies. It was an analytical category, a way of grouping similar stage economies for investment analysis. It was not originally a political bloc. It was not an alliance. It was a framework. The fact that it became an actual political summit that nations began meeting formally in 2009 is itself significant. The 2023 expansion to include Saudi Arabia, Iran, UAE, Egypt, Ethiopia, Argentina is even more significant. They look at this bloc and immediately ask, can these countries agree on a single currency? And the answer to that specific question is almost certainly no. Brazil and China have competing export interests. India and China have an unresolved border dispute. Russia is under sweeping sanctions. UAE and Iran are bitter regional rivals. Getting these nations to agree on a monetary union would be like getting the US, the Soviet Union, France, and 1970s China to agree on a shared currency. The financial media is correct when it says a BRICS reserve currency is not an imminent threat, but they are asking the wrong question. The right question is, how much dollar-denominated trade is BRICS quietly eliminating right now without building anything new at all? 4 separate mechanisms, each modest in isolation, each already functioning, each chipping away at a different pillar of dollar dependency. Mechanism 1, bilateral local currency. Trade agreements, eliminating dollar as intermediary currency. When 2 countries settle trades directly in their own currencies, the yuan, the rupee, the rial, the ruble, every transaction no longer creates demand for dollars. China and Russia. Trade in yuan and rubles, essentially abandoning dollar settlement entirely after 2022 sanctions. China and Brazil. In March 2023, a direct 1 real currency settlement mechanism, eliminating the dollar in the world's largest bilateral South America-Asia trade relationship. India and Russia. India settling portions of Russian oil imports in rupees. India and UAE, a direct rupee dirham settlement framework established in 2023. None of these agreements replace the dollar globally, but each one represents a portion of global trade previously conducted in dollars now conducted without dollars. The cumulative effect of dozens of these agreements, signed quietly without press conferences, is a structural reduction in transactions that require dollar acquisition. Mechanism 2, Project mBridge, Central Bank. Digital currency settlement, the dollar bypass infrastructure. Project mBridge, a collaboration between the BIS Innovation Hub and the central banks of China, Hong Kong, Thailand, UAE, and Saudi Arabia, allows central banks to settle transactions directly and in real time without routing through SWIFT or using dollar correspondent banking. SWIFT, the Society for Worldwide Interbank. Financial telecommunication is a messaging network. When a company in Thailand pays a company in Saudi Arabia, it historically routes through a US bank, clearing in dollars. mBridge eliminates this routing. Central banks settle directly. No correspondent US bank, no dollar clearing, no SWIFT messaging. In October 2023, mBridge completed a minimum viable product, a functioning prototype with real transactions settling between the participating central banks. Saudi Arabia joined the project in 2023, when the world's largest oil exporter joins a platform designed to settle international transactions without dollars. That is not a footnote. That is the story. Is mBridge replacing SWIFT tomorrow? No. Is it at scale? No. Is it a functioning, tested, real-time settlement mechanism that central banks are actively developing? Yes. Unambiguously, yes. Mechanism 3, the Shanghai Cooperation Organization Energy Framework, commodity settlement in non-dollar currencies. The SCO includes Russia and China, the world's largest energy producer and the world's largest energy importer, respectively. It includes Iran's substantial oil reserves. It includes the Central Asian republics' enormous natural gas. Within the SCO framework, there is an active and ongoing push to settle energy trade in the national currencies of member states rather than in dollars. Russian natural gas sold to China settled in yuan. Iranian oil sold to China settled in yuan. The Central Asian Energy Corridor increasingly priced in non-dollar currencies within the SCO framework. If a substantial portion of global energy is settled in non-dollar currencies between SCO member states, the fundamental premise of the petrodollar system is being eroded by thousands of individual transactions every day. Mechanism 4. The Contingent Reserve Arrangement. The BRICS alternative to IMF dollar lending. One of the key pillars of dollar dominance is the role of the IMF as lender of last resort. When a developing country's currency collapses, it goes to the IMF, which lends in dollars, attaches conditions, and reinforces dollar dependency. In 2015, quietly, with almost no Western media coverage, the BRICS nations established the Contingent Reserve Arrangement, a $100 billion mutual financial support fund. The CRA allows BRICS member nations to access emergency liquidity without going to the IMF and without the conditions and dollar dependency that IMF lending imposes. Is the CRA at IMF scale? Not even close to $100 billion versus the IMF's multi-trillion capacity. But it exists, it is operational, and it is another brick removed from the architecture of dollar necessity. Now let me put the 4 mechanisms together because the cumulative effect is what matters, not any single mechanism in isolation. The BRICS Plus nations represent approximately 45% of the world's population, 28% of global GDP, and a majority of the world's proven oil and natural gas reserves. If these nations increasingly settle bilateral trade in local currencies, Mechanism 1, every trade transaction within that bloc reduces dollar demand. If they build functioning real-time settlement infrastructure that bypasses dollar correspondent banking mechanism, 2, the transaction cost advantage of the dollar is eliminated. If they price energy within their own supply chains in non-dollar currencies, Mechanism 3, the foundational link between energy and dollar demand weakens. If they provide emergency liquidity alternatives that reduce the need for large precautionary dollar reserves, Mechanism 4, central banks globally have less structural reason to hold as many dollars. None of these mechanisms requires a single new global reserve currency. None requires the dollar to disappear. They only require that marginal transactions at the edges of the dollar system gradually acquire alternatives. The dollar's share of global foreign exchange reserves has declined from approximately 71% in 1999 to approximately 58 to 60% today. That is a 113 percentage point decline over 25 years. That pace of decline measured in decades, not years, is exactly what the 4 mechanisms would predict. Gradual, measurable, structural, not a crisis, a trend. The question for silver investors is not, when does the dollar collapse? The question is, if this trend continues for another decade, what does it do to the purchasing power of the dollar and the relative value of hard assets? Every analysis I have ever read about BRICS and precious metals focuses on gold, and the gold analysis is correct as far as it goes. But here is the asymmetry most analysts miss entirely. The BRICS expansion is not just a monetary story, it is an industrial story, and silver sits at the intersection of both in a way that gold does not. China dominates solar panel manufacturing, approximately 80% of the world's solar panels. Each panel contains approximately 20 grams of silver. The energy transition China is funding consumes silver at industrial scale. The Shanghai Gold Exchange, which also handles silver, has seen record physical silver delivery volumes in recent years. Chinese retail investment in silver has grown substantially. China leads global EV production by an enormous margin, and EVs use silver in electrical contacts, battery management, and charging infrastructure. Silver is being pulled in 2 directions simultaneously. Monetary reawakening, pulling it as a monetary asset. Industrial expansion, pulling it as an industrial input, both forces moving toward higher demand. Global silver mining output has been essentially flat for the past decade. Primary silver mines have not been opened at a pace matching demand growth. Most silver is mined as a byproduct tied to copper, zinc, and lead economics rather than silver economics. The supply side is not responding. The industrial demand growth alone, driven by solar, EVs, and semiconductors, is sufficient to tighten the physical supply balance over the next decade, even without any monetary demand component. The monetary component, driven by petrodollar erosion and the BRICS mechanisms, is an additional demand driver on top of an already tightening supply-demand balance. India is the most complicated member of the BRICS bloc, and in some ways, the most important one for understanding where this story goes next. India is a BRICS member that has deep strategic alignment with the United States. It is a founding member of the Quad explicitly designed as a counterweight to Chinese influence. And yet, India has been one of the most aggressive pursuers of non-dollar trade settlement of any BRICS nation. India dramatically increased its purchases of discounted Russian crude oil after the 2022 sanctions, settling in currencies other than dollars. India's trade with Russia went from negligible to substantial in the space of 18 months, a structural shift, not a temporary anomaly. India's population will surpass China's within this decade. India's GDP growth rate is currently the fastest among major economies, projected to become the world's third largest economy by 2027. India's industrial modernization, including its own energy transition, will create enormous structural demand for silver through the same solar, EV, and semiconductor pathways that China already activated. If India's industrial trajectory tracks even a fraction of China's trajectory over the next decade, the industrial silver demand story is about to get a second major engine. And for silver investors, India's trajectory is the single most underanalyzed factor in the demand picture. Metric 1 update: dollar's share of global forex reserves, approximately 58 to 59%, consistent with the multi-decade declining trend from 71% in 1999. Metric 2 update: UN settled oil trade, below 5% threshold. Bilateral Saudi-China. UN settlements continue, overall share growing but not yet at signal level. Metric 3 update central bank gold purchases above 300 tons per quarter. China, Poland, Singapore, Czech Republic most active buyers. This metric is at signal level readings. Metric 4 update gold to silver ratio 80-90.1. No meaningful compression toward 60.1. Silver continues to underperform gold on a ratio basis. Metric 5 update US Treasury auction demand, some softening relative to 2021-2022 levels. Mild concern, not yet at signal threshold. Summary assessment: 1 metric at signal level, 4 in monitoring territory, early stage structural stress environment, no full convergence yet. I committed to updating all 5 metrics every episode. No selective reporting, no goalpost moving. If signals normalize, I'll tell you. If they deteriorate, I'll tell you. I want your take on the India question in the comments. Do you think India's industrial modernization will generate a second major wave of silver demand that rivals what China created? If you watched episode 1, and this is episode 2, and you're still here, subscribe. Not for me, for the continuity. Each episode builds structural understanding the next one requires. Episode 3 topic: what happens to the US Treasury market when petrodollar recycling slows? The implications for interest rates, inflation, and hard assets are enormous. The question I want you to sit with: if the dollar's reserve share has declined from 71% to 58% over 25 years without any dramatic crisis event, what is the trajectory over the next 25 years if these 4 mechanisms continue to expand? I'm the stack guy, stack smart, stack with data. I'll see you in episode 3.